Welcome to episode 3 of The Grow. I'm your host, Scott Sinclair. This week we'll be covering a restructuring primer for the cannabis industry. That's right, a restructuring primer, not for professionals, not for lawyers and accountants and insolvency practitioners, not that level of detail, but something for management, for business leaders, for executives running cannabis businesses that maybe need to make use of the bankruptcy laws. As a reminder, if you listen to episode 1 and 2, you will know that the Grow podcast is about business fundamentals applied to the business, the industry of cannabis. This podcast is about moving past the negativity of the prejudices of the industry and exploring the hypothesis that there is in fact money available and profits to be made in the business of cannabis. We're not going to talk on this show about the commodity or the genetics or the efficacy or societal benefits. It's not about regulations. It's not about the hot new product of the day. Those topics are for other podcasts. Instead, we're going to talk about leadership, management, controlling the things that you can control, about making money, improving cash flow, and restructuring fundamentals. That was part of that line, which we'll be covering today: raising capital, creating shareholder value, and realizing on that shareholder value. That is the focus of The Grow. In this episode, like other episodes, have been brought to you or is brought to you by Sinclair Range. Link in the notes. You can see what Sinclair Range is by clicking on the www. Sinclair Range helps all businesses, including cannabis businesses, raise capital, turn around operations, restructure debts, and generally execute all of the strategies that we discuss on this podcast, The Grow. Check out Sinclair Range at the link and reach out to discuss for free your specific situation. Going bankrupt sounds bad, right? Is that not a bad thing? What if I told you it could be good, or at least a necessary step on your journey? This episode is inspired by a press release from Gold Flora Corporation. They had a press release last week and then a press release earlier, actually, I guess late last week and on the weekend, somewhere around there. I'm recording this, by the way, on April 7th, 2025. So just to put some context to that. So Gold Flora Corporation, a cannabis company with subsidiaries operating across California, today announced that following its previously reported filing for voluntary receivership under the laws of the state of California, Los Angeles County Superior Court Santa Monica Division issued an order on March 28th granting the company's application and appointing Stone Blossom Capital LLC and its principal, Who Cares, as the receiver of the company. So they went into receivership. Quick note, all over the world, in any jurisdiction, you can restructure a business. The laws exist for really societal benefit. You can save jobs. It's better, we think, to rearrange creditors and to permit a restructuring than it is to liquidate everything and fire all the people. That's the general idea. So the intention of these laws is to give companies a chance to do that. And you would typically expect in Canada, for example, use of the CCAA, Companies Creditors Arrangements Act, and you would use that to restructure your affairs and accomplish all of the things that we will be talking about on this podcast. Or a notice of intent to file a proposal under the Bankruptcy Insolvency Act. In the US, you would typically expect a Chapter 11, which is very similar, not necessarily in detail and nuance, but similar in purpose to a CCAA in Canada. So a Chapter 11 would be what you would expect to have happen for a company such as this Gold Flora. The problem is, however, that Chapter 11, the bankruptcy code in the US, is federal legislation. And of course, cannabis is not federally legal. It's permitted in some states, but it is not federally legal. And therefore, you cannot use federal legislation to help you, such as the bankruptcy code. So you're not able to use Chapter 11, and you're stuck with state remedies, which would include primarily a receivership, a state receivership, and that is exactly what has happened here. But folks, it does not change the purpose and the outcome of the intended restructuring, which is what we're talking about today. We're not talking about the law or the nuance on this. So back to the press release. Pursuant to the order, the receiver took possession of all assets of the company and is authorized to take any action the receiver deems reasonable and appropriate to manage and operate such assets, including the marketing and sale of assets. The order also stays all pending and potential actions and litigations. You want me to read that part again? It stays all pending and potential actions and litigations brought against Gold Flora or its subsidiaries unless the court orders such stay should be lifted, extended, or otherwise modified upon the showing of good cause. The receiver has broad powers. It can seize, collect, manage, control, preserve, protect, maintain, liquidate, or conserve value of all of the assets of the company in accordance with California law. And accordingly, this is an important part, the receiver is empowered to sell all of the assets of the company together or separately and distribute the proceeds of such sale to the company's creditors in a manner approved by the court. So before we get into the fundamentals of restructuring, let's just talk about the context of this release. Gold Flora last reported its last reported financial statements. Its TTM trailing 12-month revenue was $125 million with an operating income of negative $40 million. I believe their net loss was around $90 million, but from operations, negative $40 million. Near as I can tell, this company has never, ever made money. Their operating expenses are growing all the time, and they're just unable to be profitable. The stated purpose of the receivership is to seek the court's protection as a result of obligations from legacy lawsuits that arose out of Gold Flora's acquisition of TPCO Holdings Corp. And mounting costs of operations of high-yield debt. Additionally, the company has received the notice of default from J.J. Astor with respect to senior secured promissory notes that were issued August 24 and December 2024. And so there's events of default. And so the senior secured creditor, think bank, but a non-bank actor, is demanding and wanting to act on its security. So this company, Gold Flora, is looking for the court to protect against that. And while preparing for an orderly sale of its California operations, so they're looking to sell the business, Gold Flora intends to continue operations as a going concern. So just like in a Chapter 11, just like in a CCAA or an NOI in Canada, they continue to operate in the normal course while restructuring their affairs. And the intended goal here, they say, is to sell the business and to continue to operate in the business is to find that they want to sell. There's 16 dispensaries and a 100,000 square foot cultivation campus. So insolvency, as I said, is not necessarily a bad thing. In fact, it may be for many of you, and I know this because I get calls on this fairly regularly, it may be a necessary part of the journey of a cannabis company, given the state of the market. It helps you get a clean balance sheet, and we're going to talk about specifically what those are. And you need to look past the stigma, what the benefits are. You need to look past the stigma of this, oh, we're going bankrupt, and that's a bad thing. These laws exist for a reason. In every jurisdiction around the world, it is better for society, as I said before, to save jobs, preserve value, than it is to liquidate assets of a business and to have the creditors recover not very much. So what does all this mean in practical terms? What are you doing when you go bankrupt? Effectively, what you're doing is you're going to a bankruptcy judge, court, and you're saying, hey, judge, I need three things from you, maybe four, but at least three things. What you're saying is, judge, I need, first of all, a stay on all creditors. So all these people that are coming after me, the secured creditor that wants to act on their security, the lawsuits, just put a stop. Put a stop to all of that. That's called a stay, and it applies to, most of the time, to all creditors. I might need a DIP loan. It costs money to do a restructuring. I need some working capital. This is called a debtor in possession loan, debtor in possession, DIP loan. And the effect of it is the judge says, hey, okay, you need to borrow $1 million or $10 million or some amount of money. No one's going to lend you that money. Why would somebody lend you that money into an insolvent situation? Well, the way that we fix that with a DIP loan is the judge says that DIP lender ranks ahead of everybody. They rank ahead of your bank. They rank ahead of the secured creditor. And so now there's some value to that loan, and you can get some money potentially from a DIP lender to restructure your affairs. So that would be reason number two. What you're asking the judge number two is, hey, let me get a DIP loan. I need to help. Number three would be, I need your help, judge, to bring all of these creditors together so I can make a proposal to them, whatever my restructuring proposal is. Because, you know, often in business, in my world, in advising companies, we try to do these things informally, which means if we have, say, 100 creditors, we send out 100 letters to the creditors to say, hey, we want to pay you X cents on the dollar, otherwise we have to file. Well, what if we get 90 of them to agree and 10 of them don't agree, and the 10 end up in big lawsuits? That's not effective. But if you go to bankruptcy court, the judge is able to issue an order applying to all creditors. So that would be the third thing you're asking for. The fourth thing you're asking for is if you are selling the business, if one of the outcomes that you intend is to sell to a third party, or even to an existing, even to a related party, to existing shareholders or to a creditor, you want to sell that business free and clear of all of the other debt. So in other words, you want to separate the assets, the good stuff, from the liabilities, the bad stuff, and you do that in many jurisdictions with what's called a vesting order. But in any event, you're asking the judge to sell the business free and clear of all obligations. So to recap, what are the benefits? Why would you go through a bankruptcy proceeding? You stay all creditors. That would include unsecured creditors. All lawsuits come to a halt, nothing anybody can do. Class actions come to a halt, nothing anybody can do. Anybody that has a judgment against you, nothing they can do to act on those judgments. It stops secured creditors a lot of the time, not always, but a lot of the time. It even puts a halt to landlords if you're behind on rents. And so that's one of the benefits, is you're putting a stay to everything. It helps you to organize creditors and to make proposals outside of a voluntary process, which I already discussed. It can help you secure a DIP loan. It can help you sell your business free and clear of all claims. We already talked about those things. But what it also does, which people sometimes don't fully understand, is you can break fixed contracts. You can break a contract which generates a fixed cost. Why do you think retail chains are always filing bankruptcy? Do you think it's because they're not making money? Yes. Their cash flow is bad? Yes. They over-levered? Yes. People aren't buying? Yes. But really what they're doing a lot of the time is they're getting out of unprofitable leased locations. They are breaking leases, and you can break, there's no other way really other than a voluntary one-on-one discussion to get out of a fixed contract. Same in the cannabis business. You can break leases, you can break fixed contracts through the bankruptcy procedures. You can get rid of some tax obligations. In Canada, for example, I believe that you can restructure your excise tax obligations, but unfortunately, they are still a director liability, so that's maybe not a good outcome for owner managers. And trickily, you can use bankruptcy proceedings, if you are insolvent, which you probably are, as a tool to go private. You don't have to make an offer and pay shareholders. You can use this as a tool to go private, and that has been done. I've proposed it before on other deals, and I think I told you in episode 1, I'm not saying 100% of you should go private. I'm saying 100% of you should consider whether that makes sense for you, whether you ought to be a public company or not. So the outcomes, so that's the reasons you want to do a restructuring and go to bankruptcy court. What would the outcomes be? Well, number one, you can restructure your debt and your obligations. So at the end of the day, what you're trying to do is you're trying to say to creditors, okay, I'm going to pay you 10 cents on the dollar immediately, or I'm going to pay you 100 cents on the dollar over 5 years because here's my business plan and that's the way that works. Or some combination. I'm going to pay you 20 cents on the dollar over 3 years, whatever that is. You're always negotiating for the amount you're going to pay and the amount of time that you have to pay it. Okay, so that's one outcome, and you just come out the other side, you have the same owners, and you've restructured some debt. Okay, that's number one. Or you can sell your business as a going concern without the obligations going along with it. If I'm going to buy your business, your insolvent cannabis business from you, do I want to assume all of your debt? Obviously not. Then I would be insolvent too. So you want to be able to sell that free and clear of the debt, and that would be an outcome from a restructuring process. Or some combination of the first two. We're going to restructure, plus we're going to sell. Okay, so that would be a possibility. Or a fourth possibility is you fail. You fail to get a deal done, and in many jurisdictions and many pieces of legislation, you would then be deemed bankrupt, and that's a bad outcome, and liquidated, in other words. And so that's a bad outcome from that. But that doesn't need to happen. These pieces of legislation are intended to help you succeed and to bring everybody together and work together. So, as I said, restructuring bankruptcy laws are critical tools in business and commerce and public policy, and you have options. Use them. And if you want to talk about this further for your specific business, feel free to reach out to Sinclair Range and give us a call. We can talk about it. That's it for this week. Wherever you listen to this podcast, whether be on Apple or Spotify or wherever, YouTube, go and hit subscribe, hit like, participate, ask questions. What topics would you like to see? Let me know. It helps a lot. This is only episode 3. We'll talk to you next week.